It's Biden's market bombshell. I'm your host, Steve Metre, and thanks for joining me today. And our lead story today is President Biden about to drop a bombshell on the equity markets. We'll show you why one expert says he's going to completely disrupt the markets and that it'll be all-out chaos. But we're going to make the case it's the economy that's likely to send stocks crashing by far sooner than the president will. Now, let's head over to Bloomberg, where he picked today's story up with a headline, as a Biden win could disrupt the markets more than Trump does, according to Tuesday, and he's uncertain how Republicans may react to a possible second defeat. The more dangerous scenario from a political point of view is that Biden wins, according to Tuesday, a Columbia University professor who spoke at the recent World Economic Forum in China. The uncertainty from a Biden win comes from how a Trump-led Republican Party might react to a second defeat for the former president. This from the author of Crash, who followed the 2008 financial crisis, suggesting the markets may see it as a less stable outcome. Now, the question I'm going to ask you, and I want you to give me a chance to give me my side of the story. Do you think if President Biden wins a second term, the markets will crash? Do you think Trump or perhaps another candidate is better option for the markets? Weigh in the comment who you think's going to win and who's the best for the markets and why, as the election's outcome could have a big impact on China and the U.S. economy. During the campaign, Trump has floated the idea of a 60% tariff on Chinese-made goods, and Biden has ramped up tariffs on Chinese electric vehicles, solar panels, and steel, as well as increasing restrictions on semiconductors. And we've noted the big reason for this, and we're seeing this protectionism happening from political elites all around the world, particularly directed at China, who's really trying to save its economy as it ramps up the output of its manufacturing sector to keep people employed and dumping it on the world. The problem now is we've gone from a scenario where we had too much demand to a very small amount of demand, and now supply is getting out of hand. This means workers in other countries outside of China are likely to lose their job. This is something that nobody wants to see as the economy around the world continues to slow. Economists have warned that Trump's trade agenda could amount to a tax increase for American households, raising prices on a broad assortment of goods. The tariff plan would also likely send inflation above the Federal Reserve's target and pressure the bank to raise interest rates. Now, the question is that likely to happen? Do we see inflation from that? Well, it is entirely possible as we look at this price here of the Consumer Price Index, that's shown in blue, against the Import Price Index for all commodities in red, both shown on a year-over-year rate of change. And while the import prices are just now above the zero mark, you can see the very strong relationship between the two, where import prices go, consumer prices follow. So if we know, particularly coming out of China, they tend to export deflation, it's entirely possible we're likely to see an increase in consumer prices if we have even more tariffs come online. But Chinese Premier Li Qiang warned earlier Tuesday of the negative consequences if nations part ways economically, while also countering criticism that his country's industrial policy has led to overcapacity, and something that should be leading to a lot of overcapacity. This is your brokerage account. As oil prices, this is from today, hold firm as traders watch Israel-Lebanon tensions of summer demand. And while traders are watching the price, my subscribers are watching their brokerage accounts go up. Why is that? Back on June 11th, this flagged on our CTA Timer Pro. We look at the machine positioning every day. We look for them when they get in deep short positions and price rallies against them. We flag our reports and our subscribers. These are your buying opportunities. But on the 11th, I said, you know what? I think you ought to hold off. This is not what I'm a big fan of. The next day, the charts changed, the market changed, and I said, look, on the 12th, this is your buying opportunity. It blew through our upside targets. We've given them stop losses, and as of yesterday, you can see this trade on the books, 12 days, up 3.74%. You want to make money like this? You want trades like this? You can too. All you do, follow the links in the description below for your 30-day trial. Start making money trading. We'll show you how. We give you everything you need to know, because while Fed's Bowman warns of upside risk to inflation, she says it's not the time to cut. The problem is the Fed never sees a time to cut. So as we make the case that potentially if President Biden reaches a second term, it could cause cause chaos in the markets. The reality is we're likely to see the economy slow even sooner, and a lot of this has everything to do with the Federal Reserve, who has no plans, at least for now, to cut. The problem is they don't realize they're going to be cutting a lot sooner and a lot deeper than they think. And we're still not yet at the point where it is appropriate to lower the policy rate, Bowman said. Given the risks and uncertainties regarding my economic outlook, I'll remain cautious in my approach to considering future changes in the stance of policy. In a moderated discussion following her speech, the Fed governor said she doesn't project any interest rate cuts this year. Can you imagine that? Repeating comments she made on May 10th. Instead, she said, shifted those cuts into future years. The reality is she's going to be cutting this year and she doesn't even know it. And the issue here is what the Fed did is they raised short-term interest rates higher than the market actually wants them. And that means, of course, the Fed's going to have to cut to get things back in balance. Here you can see the 10-year Treasury minus the 2-year constant maturity in blue. This is called the yield curve. And when it's inverted, when the blue line's underneath that horizontal black line, it means that short-term rates are low or higher than long-term rates. Not lower, but higher than long-term rates. Well, that's all due to the handiwork of the Fed. As we look at the federal funds rate in red here, and you can see what happens as the curve comes out of inversion. Well, it means the Fed is cutting rates. Bowman can't see that we're in the second longest inversion in history, and she's going to be voting for a cut probably this year. And the reason why is when you invert the yield curve and you drive short-term rates up, banks can't make money lending because they borrow at the short end of the curve at short-term rates and lend at the long-term rates. So when short-term rates are higher than long-term rates, they don't make money on the interest rate spread. Now, they can make money other ways, but they really like to make it on that spread. And when they don't lend, what happens in a debt-based economy, because commercial banks are the only institutions that can create money, what happens, you curtail the creation of credit, you slow down the money growth, and next thing you know, there isn't enough money to pay on all the debts and keep the economy growing. And that's why you get a Fed that cuts rates, or any other central bank for that matter. Here you can see the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. This shown in blue, and this is against the funds rate. So what you see is as banks tighten standards and cut credit creation, what happens, the Fed says, no, we're not going to cut, and then the next thing you know, they're cutting like crazy. And Bowman's saying she's going to push hers out to next year, maybe only a couple of them. Well, the reality is, based on history, she's going to be cutting this year and a lot more than 2. Reducing our policy rate too soon or too quickly could result in a rebound in inflation, requiring further future policy rate increases to return inflation to 2% over the longer run. And she just doesn't understand that when you curtail the creation of credit, you cannot get inflation. Now, when you've pumped the economy full of stimulus like we did during the pandemic, and that money lingers in the system, yes, it can create inflation. But over time, what happens is that money dries up, and the lack of credit creation means you cannot sustain demand, which is evident, of course, all around the world. And this is what's coming for the markets. And this is one of the cases of why it may not be President Biden, if he does win a second term, that creates market chaos, but in fact, the Fed itself. As again, we come back to the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes against the NASDAQ 100. And here you can see, as, of course, firms tighten standards, there isn't enough money to continue to drive the equity markets, and eventually they come crashing down. This time they followed the correct pattern, but investors got super bullish over the market. I'll show you why here in a little bit, but eventually there's not going to be enough money to sustain the growth rate and the high prices, and stocks too eventually coming down. The question is, if they do, and I'm right about this, do you think it happens before the election? I think the beginning does. That's why perhaps the outcome for the markets may not matter. It may be more about the economy, as now we shift to the U.S. consumer, where we find confidence declines on weaker outlook for the economy. And when, of course, that declines, it means stocks are going with it, as you'll see. The Conference Board gauge of sentiment decreased to 100.4 from a downward revised 100.3 reading in May. The median estimate called for a reading of 100, so right on target, as June's measure of expectations for the next 6 months fell nearly 2 points to 73, while present conditions increased from a downward revised May reading. So what you see is Conference Board is saying consumers less confidence, and they're less confidence in their outlook of the economy. And what does that mean? Less spending. As confidence has been subdued over the past few years as consumers contend with a higher cost of living, elevated borrowing costs, and more recently, a softening in the labor market. And that's critical because when people start to realize that their job may be at risk, they stop spending as much money. They start rebuilding their savings. They start paying down on their debt. And of course, that leads to a less demand. Only 12.5% of consumers expect business conditions to improve in the next 6 months. That is the smallest share since 2011. And consumers also pared back buying plans. Here you can see it for motor vehicles and major appliances versus your finance. And why are they doing it? Well, one is the labor market. They're not confident in the economy. The second is the banks don't want to lend, and the rates they do are so high, consumers don't want them. But more response indicated they tend to take a vacation in the second half of the year, reflecting a pickup in travel plans, but doesn't note how much money they're going to spend. Consumers' view of the current labor market improved slightly. Some 38.1% of consumers said jobs were plentiful, up from 37% in May, while fewer said jobs were hard to get. The difference between these two, a metric closely followed by economists to gauge the labor market strength, rose for the first time since the start of the year. But what we note is the labor market is starting to unwind. And what you see here is when confidence goes, equity markets follow suit with that. Here you can see the University of Michigan, because the Federal Reserve database doesn't hold the Conference Board's data. What you see in blue, confidence goes down, equity markets follow, which explains why we saw such a drop in the markets back in 2022. But confidence rebounded on hopes the economy was going to boom. This is starting to roll over, putting stocks now on notice well ahead of the elections. And there's further evidence the U.S. economy is deteriorating even faster than most expect. Again, with the elections now a mere 5 months away, we may actually end up in a case where the economy falls apart well before that. As we turn to the Philly Fed, the fifth district manufacturing activity slowed in June. The composite manufacturing index increased from 0 to -10, indicating a further contraction. Shipments fell, went negative, new orders decreased and went further negative, and employment stayed negative, although slightly improved. Let's take a deeper look here. When you look at the numbers, it looks terrible because you see the volume of new orders, firms on net saying there was a decrease. Backlogs, massive decrease. A lot of firms saying, look, they're working through their backlogs. That means when you get through those, you don't need employees. The capacity in the factory continues to contract. That means inflation's coming down. You see the number of employees dropping, but how about that? Wages up a little bit. But what's notable to me, you talk about inflation, prices paid by manufacturers up a bunch over May. But what's happened now, prices received not up nearly as much as they wanted to be, suggesting that, again, demand from the economy is decreasing in a big way. And it's not just the manufacturing sector that's going, because by the time we start to see the elections arrive, we got a number of months ahead of us. And that means the unemployment claims likely to increase, particularly as we look to the services sector that everyone pinned the hopes of the U.S. recovery on, as again the Richmond Fed noted revenues index fell from 3 to -11 in contraction. Demand edged down to -2 in June in contraction, and future revenue and demand decreased but remained slightly in positive territory, and this just does not look good. The employment index edged down from 6 in May to 3 in June, suggesting on net hiring, but not as much, while most firms continue to report wage increases. The availability of skills index edged up, suggesting little change in firms' ability to find workers as more people hit the unemployment line. And while over the next 6 months, firms expect to increase hiring and anticipate little change in their ability to find workers, the question remains is, will the economy hold up? Look at this. Revenues negative, demand negative, local business conditions negative, capital expenditures negative, equipment and software spending negative, services spending negative, and yet they believe in 6 months they're going to be hiring employees. Yes, they added them, wages still growing. The reality is prices paid up, prices received not moving as fast as they need. This is not a good sign for the economy at all. And when we look at the relationship between the manufacturing sector and sentiment, well, we can see a very strong relationship here. Here, going back to the University of Michigan Consumer Sentiment Survey, this is against the Philly Fed Current General Activity Index. And look at the history we have on these two, which is significant. What we've noted, the Conference Board in both the University of Michigan says confidence is coming down. That means the factory activity is following suit. And when that goes, the labor market goes, and so too does the equity markets. It may not be Biden that causes market chaos this time. It may be all about the economy and the Fed. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.